More on Ben Bernanke's inaugural press conference and what he's likely to say about the economy. Let's talk to a currency expert who's a senior markets consultant at Saxo Bank, Nick Beecroft. Hi, Nick. Morning. If you were at that press conference later, you had the chance to ask the first question at this historic meeting to Ben Bernanke. What would you ask him?
I'd probably ask him whether we will ultimately see QE3.
Which you think will happen?
I suspect it will down the road, probably in 6 months' time. I think there will be an hiatus while they see how the economy reacts to the absence of QE after its natural demise at the end of June.
So what's going to be the factors, the economic factors, the fiscal factors that preempt QE3?
Well, the Fed sticks to its dual mandate and the requirements flowing from it. So if we see employment failing to rise, unemployment failing to come down, and if we see core CPI turning over again, then I think QE3 is a shoo-in. It'll definitely happen.
What are the implications then for various asset classes, for the S&P 500 and for the dollar, which is close to a 3-year low?
Well, I think there's a possibility that the dollar has something of a recovery in Q3, after the end of QE2, before QE3 starts. So we can see a recovery there, and possibly that could also coincide with crisis in the Eurozone as we move to a possible Greek restructuring, voluntary restructuring, and the implications of that, possible contagion onto Spain.
You're looking at voluntary restructuring when then for Greece?
I think Q3 sounds good, doesn't it?
So Q3 is going to be a fascinating time for the globe, isn't it? Lots of varying factors pushing and pulling various asset classes. It's going to be tricky, isn't it, to know how to position yourselves?
I think in terms of currencies, the safe haven currencies with current and capital surpluses, so the Swiss franc, the Norwegian krona, the Canadian dollar, the yen, they're looking very good. If you have more risk appetite, I think there's still mileage in the yield play, in the Mexican, the Brazil and the rand, but that's going to get tricky, as we've said, as Q3 comes along with its challenges.
And because of QE3, you don't like government bonds?
No, we have a medium to long-term fear of government bonds. Either growth does become self-sustaining when all the stimuli disappear, and then the major central banks, including the Fed, are behind the curve, indeed possibly still printing money, in which case the bond vigilantes will be out in force, or we see crisis 2.0 in as we call it, in the Eurozone, which will involve massive fiscal cost for Germany and France particularly.
What's that going to do then to the European economy? I mean, is it going to send it possibly into recession again or not? Well,
we have a very strong German economy at the moment, certainly, which is acting as the locomotive. I think it will certainly cause a knock in confidence. If we have a severe effect of contagion, a Greek restructuring onto Spain, the potential damage to the banks that will cause throughout the Eurozone.
Because some have said there could be sort of Lehman-type comparisons if it does spread to Spain and the effect on banks.
The pockets of Germany, France, the Netherlands, the rich northern countries are large enough to bail out, in the end, to bail out even Spain. It won't be popular, but there's a massive political will to do it. All that means is that bonds don't look a particularly good investment.
And safe havens mean that gold continues to look a good investment?
Gold, commodities, all driven by QE. QE is the big game in town. All driven, all liquidity driven, and that can continue throughout the year.
Nick, thanks for joining us today. Saxo's Nick Beecroft today.